Let's go ahead and get started, guys. We want to welcome everybody to the tax-free cash flow. Today, we're going to talk about paying less taxes, building passive income, achieving your financial freedom, and how to do these smart investment moves, and how to do them with investments that really pay dividends, and how to actually save money before you ever get started. So today, we're going to discuss why the IRS wants you to invest in oil and gas. And if you haven't been here for some of our other comments before, the tax code is not a penal code, ladies and gentlemen, boys and girls. It is a encouraging manual on what the IRS and the government wants you to invest in. And the quicker that becomes your mentality and your mindset, the quicker tax-free cash flow comes about. And guys like Kyle, guys like Larry have been doing this a long time and they know how to get it done. That's why we're going to help you guys today figure out how you can be the tax-free Beverly Hill-Billies with oil and gas. So we want to welcome you. I am your host, Shannon Robnett, and I've been involved with real estate since I was an indentured servant at the ripe age of 8 when my parents were both in construction and development. I'm a 4th-generation realtor, 2nd-generation builder and developer, and I've done over $400 million worth of construction projects ranging from moving a house to large multifamily projects, building schools, office buildings, industrial parks, mini storage. I've done it all. And here to help me anchor this thing and bring the tax perspective is my co-host, Larry D. West III. Go ahead and introduce yourself. Tell us a little bit about you.
Absolutely. I appreciate the lob there. So, hey, everyone, Larry D. West III, tax strategist based here in Dallas, Texas. And what the heck is a tax strategist? We've heard of CPAs, EAs, accountants, and the like. As a strategist, what we do is essentially we sit down and look at the entire picture. A lot of what Shannon just mentioned, when you get into the real estate space or perhaps any business, tax planning and tax strategy become that much more important. And we help you devise those plans and strategies. Hold on to more of that money, send less of it off to the government, and build generational wealth.
So there you have it. And guys, just to be clear, I'm glad Larry explained that because his wife was asking me the other day, what is a tax strategist? And I had to kind of just say, I don't know. But also, guys, in Larry's defense, he is a recovering accountant. Okay. So he is working through that, trying to get back to the right side. But today,
step 8 right now. Step 8.
Right. That's right. That's right. You're slipping into the dark side. But today we've got a special guest, and Kyle Slagle is a friend of mine that I've gotten to know over the last couple of years, and he's the founder and the managing partner of the Real Asset Investing Team. Kyle is going to walk us through his top 3 strategies to create massive tax savings. So Kyle, welcome, and tell us a little bit about yourself and how you got to this position in your journey.
Well, thank you much, Shannon. Yeah. So it's been a pleasure to get to know you over the last couple of years. And I got here probably by accident. I'm also a recovering professional. I was an engineer by trade and ran into my own issues with taxes. And so I had to become my own professional, tax strategist, if you'd say. I didn't know that was a category, right? And so when I hear Larry introduce himself, I'm just going, my gosh, I went through all of that. I'm on step 1. He's on step 8, which is great. So congratulations, because I'm unlearning, right? I'm unlearning what an engineer used to do and what I thought was making money for me. And so essentially by doing that, I would tell you, I've been through the gamut. I've invested across the board in many assets. I was in the stock market. I was in local real estate. I've been in multifamily apartment buildings. And at one point, if you want to know how crazy I got with the tax code and being, a strategist and trying to find anything I could to help me, we also now own a speedway. So there's NASCAR tax loopholes. We got all the way through that. We also own that now because we were looking for these tax incentives and trying to figure out, what best was at our hands to invest in.
I can't wait to tell my wife I'm buying a race car to go with my hair.
Yeah.
This is really going to be good. Larry, you got a place I could stay for a couple of days after I tell her that.
Yeah, that conversation goes over well. So through all that, I was able to, retire, semi-retire, if you want to call that, a little bit early, and kind of go into my passion project, which is helping people reduce their taxes through investments. I like putting deals together, and I like investing myself. And so ultimately, at Real Asset Investing Team, we've developed a team of experts to come around us as well in what we're going to invest in. And we've just opened the door and said, hey, if you want to invest alongside us, you can. come with us through that. So that's how we got started, and that's kind of how I got here. That's a little bit about my background.
So, Kyle, being an engineer, you've got a very linear, logical thought process, right? And one of the things that I've struggled with, right? I can put my hands on a building, but I can't really put my hands on an oil well, but I need it for my car, right? So in my logical thinking, I'm missing a couple steps here of walk me through why investing in an oil well is different than just buying gas at the pump, and where's the tax savings in that, and why does that happen? And then Larry comes in and tells us exactly what page that's on in the code.
Right. So investing in an oil well, I would say that I can put my hands on it, right? So to me, I've internalized that's a real asset. I can go to the field if I want to. I can touch that, those tangible assets, right? And also a part of that, though, which makes it somewhat phantom, you're talking about, is the intangible drilling cost, right? So you're drilling a hole in the ground, and now what do you own? You own a hole, right? But that's kind of a part of the oil and gas investing. And we enjoy that piece because of tax benefits it brings, not because we want a hole in the ground, but that's the tax benefit side. So it is still a real tangible asset that we own. We then also, make cash flow from the production of that well. So just like you would in real estate, renters come in, they pay the cash flow in, you pay expenses, and what's left over you keep as an investor. So same thing happens with the oil well. It's not a human renter, it's a commodity that we're selling on the open market. And then we have the tax benefit from the intangible drilling cost.
So Larry, break this down for me. I bought a hole. I mean, look, I bought some dumb stuff. I'm not going to say I haven't, but why does the IRS want to give me credit for the hole before I have to recognize the profits that come out of it?
So that's a great question, and I love the analogy to real estate there. Essentially, you didn't buy a hole. What you bought was the equipment that was used to make that hole, and then you're going to get an advantage from the cash flow that's produced from what's coming out of that hole. But essentially, it's not cheap and it's not free to go and drill that type of a hole in the ground. And so massive outlay in terms of cash outlay for the equipment. But here's the beautiful side. We've got the power of depreciation. And so the value that it takes to purchase those intangible assets that you use to drill that hole, that's what flows through as the tax advantage, because you get to write off 100% bonus depreciation. Oh, and by the way, just like you mentioned with the building, it produces cash flow thereafter down the line. So think about it, where you would normally build a building going up, they're just building a hole going down, and cash flow happens after that.
See, that's usually what happens to my cash flow goes down that hole. At the end of that hole, my wife and kids. But here's the thing, though. Not everybody can use depreciation, right, Larry?
Well, everyone can use depreciation, but it's going to look different for everyone. But oil and gas, as we've talked about before, is rather unique. Before we jump down that side of things, though, whether or not you can use the depreciation that comes through is a function of how profitable the business is that year, because depreciation and cash flow might offset each other dollar for dollar, or there may be an excess and a loss. And it then depends on whether or not you materially participate in the activity itself.
Well, I'm not drilling the hole.
And that's where the fun with oil and gas comes in.
Drilled a whole lot of them either. Kyle, how many holes have you actually drilled?
None, zero. I'm with you.
Yeah.
But that's where the value of this I'm going to use the term loophole kind of loosely here, but that's where this oil and gas loophole really comes in, because depending on the structure and the setup of that partnership on the front end, there may be opportunities for folks, investors in particular, to come in as general partners, materially participate, and meet that threshold so that they don't have to worry about the same standards as, say, in real estate.
So, Kyle, I'm going to assume you guys have figured that out so that I can invest alongside you. I get credit for the hole that you and I both didn't drill in the depreciation that comes out of that to offset some of that cash flow.
Yeah, you do get credit for it. And there's a big thing there with, if there's a dry hole, right, then all we have is the tax benefit. So there's a risk there in that. And one thing we've done with drilling oil wells is exactly take that risk away. So think of it in terms of real estate. And I started in real estate, so I always compare to real estate. But if you buy a single family home and nobody's there that month, you get zero cash flow. But if you buy 10 or 12 or 15 of them all in one package, if one of them's dry and the rest of them are good, you still have, cash flow to cover for one that's not performing as well. And so we went from investing, in single rounds, single holes, if you want to call it that, to saying, hey, let's put a package together. Let's do 3 or 4 or 5 all at once so that the risk goes down substantially.
So
Sounds like multifamily.
yeah,
Right.
Exactly. So that's one way to invest, right? So you can invest in the actual oil well. And then when you see things happen like the energy crisis that we're experiencing now, and you got in 5 years ago, you've taken all that depreciation, you were planning on $40, $50 a barrel oil, and it's now, what's it? Do I even want to know what it is a barrel? What's it a barrel? 85, 90?
Yeah, it's in the mid 80s.
Yeah. So now you're getting great cash flow. You're utilizing that resource. But what are some of the other ways that you can participate in the oil and gas industry from a tax savvy, a tax advantaged way?
Yeah, so one thing that you run into is if you can't use the depreciation, right, and it doesn't help offset your tax, then that could come from many reasons. One, you may not have a large tax bill, right? And so that doesn't help you a whole lot to offset 0% tax rate, right? Or even, maybe 4 or 5% effective tax rate. That's not a big benefit to you. So when you analyze that deal, you have to be looking at, do I actually, get to receive that tax benefit or not? And if not, you got to throw that piece out and analyze it as you're just receiving cash flow, right? And so what happens is as you reduce your taxes from active income in these real assets that will produce income, cash flow down the road, at some point you get to zero. And at that point, now you have a whole lot more risk in joining into a well drilling operation because you don't get that benefit, right, of the tax deduction. And so what we look at that point is moving someone or ourselves, right, into investments that are purely cash flow. So we would look at going out and buying existing production, right? And it's all about your risk profile and what you're looking for out of the investment. If you've already offset your taxes to zero, then primarily you're looking for cash flow. And we can go out to the market, very similar to multifamily. Once again, it's a producing asset. It's a proven asset. We've got 3 years, 5 years, 10 years of records. We've got geologists that look at that and say, yes, here are the reserves we believe are in the ground still, and here's the rate you can produce us going forward. What I really like about that space is it is a cash play, right, for cash flow only. But the next piece that's really great about oil and gas revenue is you only pay taxes on 85% of the income that comes in.
What is this witchcraft? Why is it? Larry, tell me, why do you get a 15% break just because it's oil and gas?
Well, this answer is similar to the last time we talked about this subject, and it's quite simple. Oil and gas had better lobbyists than some of the other industries out there in terms of negotiating these different incentives and opportunities. But it's been one of those fairly long-standing areas in the tax code.
Okay, so it's been there for a long time. So and we're talking about, Kyle, we're talking about, if I go out and buy, if I go out and buy a multifamily building, I can then depreciate the building even though it's producing cash flow. If I go out and buy the well and it's already producing, am I buying, like a business where I have the blue sky over here, which is the oil that's in the ground, we don't know how much, and I've got the equipment over here as another part of the purchase, so that at the end of the day, I do get some depreciation. And then I know that well is likely to throw off, let's say that last year that well threw off $100,000 in cash flow. IRS is only looking at 85% of that. And then I am going to get some depreciation of equipment in that purchase, right?
You can, right? So it's always important to check how the deal is set up. So as long as the deal is struck and you buy the lease and, it's kind of like a cost segregation, right? You bought some reserves and you bought a whole lot of equipment already out there. But you've got to set it up that way and you got to purchase it that way. And so if you're investing in a deal that's buying existing production, you want to ask that question, are there tax benefits? Is there depreciation coming from existing equipment? Just like in real estate with the new laws, tax laws that came about the last few years, you can redepreciate used equipment. So
Right.
it's no different in oil and gas.
Larry, he scared me there for a minute. I almost thought he was going to use your famous two words on me.
It depends.
Oh man, hear that one more time. I'm going to be in depends. So, so Kyle, what? So we know we can drill the hole, we can buy the proven asset that's already producing. How does one value that asset? Is that kind of like a multifamily building where you have it on a cap rate? It's producing $100,000 in cash flow. I'm sure it's a little bit more complicated because it would tend to be a little bit more. I would think it would be a little bit more risky than buying a building because you don't really quite know how much more oil and gas is down there, correct?
Yeah, that's correct. So it is a guess, right? And I say a guess, there's people that make a career and they're great at it, right? The geologists that go out there, the folks that are, going over the data from the actual lease that you're purchasing, all that's important to understand, what are you buying, what's going forward. But in the end, you have cycles and you have a production pattern, right? Just as you have a rental pattern and cycles go up and down. Along with that, you also have the cost of the commodity, right? So some folks look and say, okay, well, if I'm buying the reserve, now I got to put commodity price in there to know and project what's that going to be down the road. I go back to a very simple approach. I'm buying cash flow in a tax advantaged way. And so the cash flow I look at is say, okay, here's the last 3 years, here's the last 5 years, here's the last 10 years. What cycles are we seeing? What can we then interpret and put that out to a forward projection, right? And then we're going to stress that a little bit. Say, okay, what if the price does drop 30%? Are we still good, right? What if, one of the wells breaks down and we've got to repair it? Are we going to consider 100%, utilization, or we throw some extra vacancy in there? I call it economic vacancy, right? In a rental apartment, you say, hey, what percent vacancy do you have? I say economic vacancy. That well may only produce 300 days out of 365. And so we can start applying some stress to that lease purchase, that asset, and then develop a well-rounded strategy for buying it, holding it, and then how we're going to profit from that.
Well, and you already know that your ordinary income that you're going to get off that cash flow is you're getting the 15% favoritism because of the great lobbyists. So what are some of the other cash flow plays or not real estate, but tax advantage plays that you have? You and I have talked about a couple of them. What are some of the other ones that you do on a regular in your business that are involved with oil and gas? You make your money on oil and gas. So when commodity prices go up, it's really good. When commodity prices go down, it's not so great. But what are some of the other strategies that you employ?
Yeah, so there's kind of 3 different tiers that we look at, and we try and focus just on that. One is you need a lot of tax mitigation, right? That's going to put you in a particular classification. Let's call it tier 1, right? The other one is you need a medium amount, maybe tier 2. And then number 3, you're saying, hey, look, I'm good on taxes. I just want some extra cash flow. I want to be a passive cash flow investor, right? And then that's for actively producing income. We call that offense, okay? And that's what we're going after. Then we have some defensive strategies we want to go after as well. So let's go into real estate right now today. How do we merge real estate with oil and gas? Well, you can look at some 1031 options, right? If you have real estate, you can buy real estate with mineral rights as well. And so if you don't want to go back into, housing necessarily as the production asset, you have land, you 1031 it into land. That new land just has the mineral rights. And so now you're a royalty owner, right? You get royalties from that land. And so that's one way. Also, as different asset classes cycle at different times, you're able to shift back and forth between those. So that's another way we invest, is just owning the land, and then you receive a royalty or percentage of everything that is drilled or produced on that land. Another way is with oil and gas is equipment. And I know you guys have had some talks about equipment, but equipment's great as well because you can bring in leverage. Leverage is a double-edged sword, right? So anything that you buy with leverage, you have to repay that back out of cash flow in the future. And so there's tax incentives or tax consequences to that. And I would say it can be incentive or consequence based on your scenario, right? There's ways to use that to your advantage because you're recouping it down the road. But so we would use, we talked about the 3 ways to invest in oil directly in the field, right? You can buy the land, own the royalty, you can own the well, or you can buy production, which is the lease. Then we talk about 1031 strategies to help you avoid, paying taxes. I say avoid, and I want to use that word cautiously, right? We're trying to do what's right by the tax law. So avoid and evade are 2 different things, but what we're saying is we're trying to be smart with our tax money, and that's an option out there as well. And then we have this.
Kyle, hold on just a second. Let's back up just a little bit. So I just sold a project and I got $100,000 and I want to get into oil and gas business. If I have capital gains, what I hear you saying is the only way that I can get involved in the oil and gas business and not pay taxes on it is to do a 1031 into the land. That's
not necessarily true the way you stated it. You could 1031 into oil and gas.
And Larry's going nuts over here. Yeah. Larry's like, "Oh, get him." Okay, go ahead. Tell me why. Tell me how I was incorrect.
So here's what I heard. You said if I have capital gains from real estate, the only way I can get into oil and gas is to 1031 into. That's not true. You could get into it after tax, right? But you got to pay tax first. But if you want to get into it tax free, you could turn 1031 into land purchase with the rights, with the royalties. That's a way to get in if it fits your scenario. Again, as Larry's seen with many different investors probably, is it has to fit your tax scenario. What we're seeing is if you get that wrong, if you get your effective tax rate wrong as you're making future investments throughout the year, these investments may not work for you at all. And sometimes they're very detrimental. So you can get into oil and gas from real estate to oil and gas through 1031. It's not a common strategy you hear about, but today with the energy crisis we kind of have going on, it's becoming more and more acceptable to talk about that, right? People may be selling at a high, not wanting to go right back into real estate or diversifying at this point into different assets.
So now, Larry, let's bring this home. So we have in a 1031, we have to go like for like, and we're like enough, even though we sold a multifamily project or an industrial building, we can buy land because it's still real estate, is still real property.
Right.
So we can do the 1031, and that's going to defer that tax gain. But then once we get there, we've deferred that. Now we've got the hole we drilled, right? And we may or may not have been a part of the whole drilling process. We may just have the rent. Now, if we go through that, is there any benefit to oil and gas and mineral rights in that 85% tax bracket? Do I get any of that? Or is that, because it's a royalty or royalties taxed the same as rent would be taxed? Is it a distribution? Is it, where's the advantage in that?
Yeah. So the bottom line there is that, the cash flow itself will still be taxed at your ordinary income tax rates, right? And so it's almost no different in that sense. And so you do the 1031, you roll into the land itself, and then you collect royalties, which is the same as you collecting rents had you rolled into another building. The difference there, though, and jumping back to what was mentioned a moment ago, is if you're not careful, it could basically destroy or basically erode the strategy you were trying to go into. Because when you go from one building to the next with some basis adjustment, you're still going to have the opportunity to depreciate that next building. When you roll into the land side of things, assuming all of the drilling has happened, there's no new equipment purchase or anything like that, you may not have large depreciable items to offset the cash flow you're going to go into. So if your goal is number 3,
recapture, right? Plus, I mean, if I already depreciated out my other building, now I got to recapture that, right? Because I sold it.
You did a 1031 exchange.
Did a 1031. But I've already lost that depreciatability, right?
Yep. And so there's going to be a nuanced basis calculation. So your new basis in the land that you just purchased is not going to be what you may think it is from the seller statement. But the point there is you may or may not have the additional equipment to purchase where you have the large depreciation offset the cash flow that you're going to get from the royalties. So if the play is purely a cash flow, something like that sounds really good. And if the opportunity exists, it's worth looking at. But if the play is to defer tax and to continue to defer tax, well, we may want to look at one of the other options that were mentioned before. The point is, it has to fit your scenario.
Yeah, and I'm just going to jump in here real quick. So it is like a milk and cereal process, right? As you get rid of taxes, you also want more cash flow, and so you're creating a problem and solving it as you go. And so in that scenario, you would transfer over. Now you're getting royalty income. You do still get the depletion deduction on that, but you still have excess income that you have to pay tax on, right? But what it does is you've done it in such a way that you can do it from the passive side, right? We've kept everything over on the passive side. Much easier to get a passive deduction through an investment than an active deduction, right? And so you've opened up your ability to bring in new depreciation or new deductions from the passive side from a multitude of asset classes, not just one.
Sure. So then we bought the land, we did the 1031, we drilled the new well, we've got the new equipment, we've taken our depreciation that way. We're now into the production side. And now you were talking about equipment and other products that you're bringing on with leverage. And so the thing that, just like with multifamily or industrial with real assets, where you're able to get that leverage that then allows you to buy $1 million worth of stuff with $300,000 worth of cash, right? That allows you to get more depreciation that drops down. That's all on the active side though, right?
It can be on either side. It depends on how you invest, right?
Okay, so let's break this down. Because
Yeah.
you just mentioned, and this is very key, and I think, Kyle, you're bringing up a lot of really good points that this is why we have this conversation, right? When you're looking at being active, I'm very active in real estate. I have no problem with my active, side of things, doing all of that. But a lot of people have passive problems, right? They are passive in the real estate. So when they come on and they look at depreciation from the cost segregations, a lot of times those don't work for them and they're looking for that passive. So explain to me how you would set your stuff up on the oil and gas side to help my passive investment side get that deduction. Because that's really what a lot of people are looking for right now, is that passive investment side.
Okay, and so just to get the scenario right, because it is very detailed, right? And so we'll go back and forth to make sure this is right. But what you're saying is, on the active side, you're good. Because you're a real estate pro, you have plenty of deductions on the active side. You don't have any tax issues there. But as you invest passively in something, now you're needing more deductions because your passive cash flow has no offset.
Well, what I'm also saying, though, is a lot of my investors that like to invest are passive on anything, right? They're passive. Sure. So they're looking at it. They're going, well, Shannon, I can't really use some of the deductions that you use. That's cool for you. But how I want to make an investment that gets me passive deductions. Where are my passive deductions?
Yeah. And so I think what you're saying is they want to be a passive investor, but they want active deductions because they're not real estate pro. Is that what you're saying?
Yeah. They've got income.
Yeah.
They want to offset it.
Yeah, so they've got income on the active side they can't offset with general real estate deductions, and that's simply because they're passive or active, right? So what's great about the oil and gas side is you get to choose, right? What the tax code says is as long as you invest in such a way that you hold the asset and you do not limit your liability, that's the code exemption, right? You don't limit your liability. Then you can take your working interest in oil and gas and bring those losses over. And it doesn't say you can bring them over. It says the passive loss rules don't apply. That's what the code says. Okay, so now if I invest in oil and gas, it becomes very, very critical that I know how I invested. In real estate, you normally hold your investments through an LLC. If you do that in oil and gas, you do not get an active write-off. You can't jump that line. You have to invest in such a way you don't limit your liability. So that leaves you a couple options. One is in your own name, right? This is straight up in your own name, which probably isn't a great asset protection strategy.
That sounds awesome.
The second is you develop an LP, limited partnership, just like you would an LLC, and use the LP entity to be a general partner in that, and now you control your active and passive status on your side.
Okay.
So I'd love to go back and let you guys discuss that.
So what I'm going to do is, instead of create an LLC, I'm going to create an LP. And just like the LLC, it's going to give me the protection, me personally, the protection. And then I'm going to put the asset in the limited partnership. And then I'm going to be able to buy equipment. I'm going to be able to buy things that pertain to oil and gas industry. And I'm going to be able to decide on December 30th whether I want to take those and call those an active investment or a passive investment. Is that what I'm hearing Kyle say, Larry?
No, that distinction needs to be made up front, and a few differences from what Kyle said and what you eloquently translated there, Shannon.
It's very unusual that I get it right the first time.
So the key thing to point out there, though, is where he talked about limiting your liability, and that's where you have the opportunity to come in as a general partner. Your LP that you created, your limited partnership that you created, is a general partner inside of the partnership that's actually doing the activity. And so if anything happens, we know the general partner, their exposure is a lot greater than the limited partner, which is that little sneaky thing that allows them, and this is only for oil and gas, this does not work for real estate or anything else. Right. That sneaky little thing is what allows them to bypass the passive activity loss rules. So you have an LP, it takes your general partner interest inside of the company that actually goes and does the drilling. But you have to make that election up front. It's not one that you wait to the end of the year or perhaps next year to decide.
So I decide, Kyle, you and I are gonna drill a hole, or you and I are gonna lease some equipment, and we're gonna do this deal. I create an LP. I join the active as a passive, and I tell everybody I'm gonna take these losses.
Not as a passive. You're joining as an active participant.
I'm joining as an active participant, but asking for the profit and loss, all of my activity be considered passive. Is that correct, Larry? Am I saying that right? Am I holding my mouth right?
No, not if you want those losses to flow through as active losses. So this is when you're doing the planning on the front end, we got to figure out, are we trying to mitigate active income or are we trying to mitigate the passive side? For most of the people that you talked about at the beginning, Shannon, they're trying to mitigate their active income. They're probably high W-2 earners, high business income earners. So they want to come in on the active side, general partner, so that they can take advantage of those losses.
I switched roles and I went back to my other personality. So with that, by taking those active losses and setting it up that way, I can still be a passive investor. I am still not the guy that does everything. I'm not dispatching the truck. I'm not filling it up. I'm not washing it. I'm not doing any of that kind of stuff. Kyle's still in control of all of that. He's making the deal go round, just like I do with my multifamily stuff. But I'm able to take those losses against my W-2 active income because that's an oil and gas election.
And because you've also foregone that liability. Well, I mean, you have the LP there, but you've foregone that liability protection as well. So that's the balance.
Yeah. So I think I got it right.
Yeah. And there's a reason through asset protection, if you look at a longer term strategy, why you would use an LP to invest in such an oil and gas deal. People invest with their own name. It's common. Okay. But if you want a little bit more control over your situation, let's say we go out and we're going to invest, in a 4-well drilling program, right? And we're all general partners. If I invest in my own name, then I am kind of at the mercy of the people drilling the wells as to when they make me a passive partner in the future or a limited partner in the future. Okay. I'm not talking about how much work I do myself. I'm talking about the classification, the tax code. Okay. So let's say I'm a GP year 1, we drill 4 wells, and come year 6, there's a big problem. Well, after we drilled the wells, after we took the tax benefit, they should have moved me to a limited partner. Okay. There's 2 things that happen there. One is it reduces legal liability. Okay. And 2, after being a limited partner for 5 years, and you can show that you have not substantially participated in running the business, you can then also change your tax election to passive as well. So you're moving that income from active to passive. Okay.
Wow.
Now, that's one reason you want to control how you do this. But if you invest in your name, you're out of control. If you invest through a limited partner, you're the general partner of your limited partnership. Your limited partnership is the general partner of the investment. Now, if they never move you from general to limited, you can move yourself inside your own LP to a limited partner. And now you've reduced that risk for yourself. You're taking more control over your asset protection strategy.
Man, Larry, it's sure a good thing that this doesn't apply to marriages in a community property state, because I would have been moved to a passive investor. You know, I couldn't help it, man. But you know, and what a lot of people don't realize is that there is always somebody looking to make a normal situation litigious, right? I mean, there are people out there that make their living making life difficult for other people. And at the end of the day, liability protection is key. So when you can have the protection plus the ability to have active income for a period and then take it as passive after that, those are all very, very good things. Now, when you look at that, Larry, is there any tax advantage if I let's say that we bought this equipment, we put it into service, and I took those deductions against my active income? Now we're gonna sell the whole kit and caboodle, and I'm gonna have some recapture, but it's moved over to passive. Is there any way that I can offset some of that recapture because it's passive versus active?
Yep. Essentially, what you want to do is have other passive losses from other investment activities that you have going on that can trickle through and potentially offset the gain that you're about to take on. The fact that you're completely disposing of that interest, whether you're active or passive, that recapture will definitely still happen for you. But the nature of the activity at the time of disposal will have implications on whether you can use other passive losses to offset it. So if that were going to happen, ideally, for most folks, they probably want to be on the passive side of that transaction when it actually takes place, and then have other passive losses from something else that can flow through and help absorb.
So what would be a good idea to, and these are, you know, Kyle, I know you do these stacking strategies where you know that you're going to be disposing of an asset that's going to have some recapture. So you're going to stack a passive loss in on this side so that you can offset that. What are some good examples, Kyle, that you've used that are passive losses that you stacked up to offset some of this stuff?
So you can use any investment with depreciation for a passive loss, and that's only going to offset the depreciation recapture portion to the extent that you have it. Okay. That is much less in equipment than it is in real estate. Okay. So the equipment has a shorter lifespan. The depreciation doesn't always have to be recaptured, right? We're not taking something from 27.5 years or 20 years and pulling it into year one, right? So I should say 20 years or 15 years pulled to year one. So there's not that recapture. We're taking a 7-year product possibly, or a 10-year product at the most on equipment, and saying, hey, after 10 years, we're selling it. So there's not really a whole lot of recapture. But let's talk about what the strategies are. So if you do have depreciation recapture and it's on the passive side, then you can invest in a number of things. You could do real estate. You know, there's ATM funds out there. There's car washes now, if you want to do car washes, right? Whatever you want to be as a passive investor that has depreciation that you're going to use year one, that doesn't also match it with cash flow year one of the same, that's going to bleed over and offset that. But there is one piece, and this is why we do consultations a lot with our investors as this becomes closer and closer to sell, and that is the capital gain. The capital gain portion is not going to be offset by your passive losses that you just generated. So you got to split that up into depreciation recapture, either active or passive, and then capital gain income. And there are strategies to offset both of those.
Yeah, you know, and that's the funny thing that we're doing, you know, with some of our stuff with capital gains, is making sure that consultation. Kyle, you mentioned it. Larry, I know you do it extensively too. You've got to sit down and you've got to understand what it is your investor's trying to do. Once they're getting into your investment, when it's time to exit, as much attention as you paid to get them into the deal. Kyle, I know you pay that kind of attention getting them out of the deal, so that they don't sit there and go, hey, Kyle, that was fantastic. You'd made me $100,000, because they're not going to remember the $100,000 when they got to write a check to the IRS, right?
That's right.
I mean, they seem to forget all the good things you did, and then your name just becomes associated with that $18,000 painful item that they had to write to the IRS. So when people are looking at these things, and I think this is important, Kyle, you and I have talked about this at length. You have a mix, even though you're primarily in the oil and gas space. Am I correct?
Yeah.
You have a mix. So 1 year you're buying holes, the next year you're buying equipment to put on that hole. The next year you're buying passive or already producing wells, and you're rotating that through so that you're always one step ahead of the tax guy, because like you said, you're deferring and or working through the taxes rather than evading, right? There's a big difference, but you're applying those strategies. So as we come to the close on this, Kyle, what are some of the things, like if you're looking at it saying, hey, this is my 5-year deal, I do this, and I do this in that 5-year cycle, or what is my cycle that you like to look at? And then Larry, we'll get some closing comments on why that is can be then wrapped in with some of the other stuff like real estate or other things.
Yeah, so I wish there was a cycle, but I would say the cycle doesn't exist, but a pattern does. Okay. So number one, whenever I am looking at my own situation or with an investor, number one is we got to say, okay, active income is hard to offset. How much of that do we want to offset and profitably offset, right? Again, if you're burning through a 0%, tax rate, that's no benefit to the investor. So what we start with is active income. Okay, we're investing to offset taxes on active income first. When we're down to 0, now we're investing for cash flow and future strategic allocation, whether that's passive or active, right? We're looking down the road saying, okay, 2, 3, 4 years from now, what do I need in the hopper in my, what I'd call your stored losses, right? Or potential energy. So you're storing, net operating losses or capital losses or passive losses as you go, right? And so we're stacking those up 2 or 3 years out, but that's it, okay? We're going to invest to offset active taxes, invest to offset passive taxes, and then we're investing for cash flow, right? Now, what does that look like? I would tell you, as the tax code change, it looks different every time, right? And as your scenario changes, it looks different every time. If you're actively transitioning from W-2 to not working and just being an investor, that looks a little different. But if we look at primarily a W-2 high earner, non-real estate pro, we always start with active tax offset, passive tax offset, and then invest for cash flow.
Right. Larry, you got some closing comments on that?
And Kyle just really put a huge bow on it. I think that's a great cycle to really follow there. I don't know that I have much more to add beyond that. Besides, it's all strategy, it's all planning. What's that?
That's the engineering and putting a bow on it.
Definitely. But it's all strategy, it's all planning, and all these scenarios will not necessarily work for every single person. You got to sit down and have the consult to see what actually works for your unique situation.
Which leads me to wrap this up by thanking everybody for being here. And like Larry has said, like Kyle has said, like I have said, guys, it's really important that you sit down with people like the quality people that Larry and I are putting on this show to get your specific tax strategies put together for you so that you can have something that you know is going to work. See, Kyle doesn't write you a strategy as your accountant. Neither does Larry. These gentlemen work with people like myself that come in. I do the same thing. We sit down, we go through it. We make sure we write something up for you. You run back to your own accountant. You get your third-party opinion before you invest. For the love of God, get a third-party opinion on what this really does for your tax strategies. Because as you saw on this conversation, there are a lot of things that we see differently, that we hear differently, that we need to make sure fit into our individual tax strategy. And a one-size-fits-most does not work with your taxes. So thanks again for everybody for being here. Kyle, thank you for tuning in. And if you want any more information on how to talk to Kyle or Larry or myself, be sure to put them in the comments or go to our connect at shannonrobnett.com. We will get you connected with these guys. Leave a review. Larry and I love to hear the feedback. And if you like what we had to share today, go ahead and give us a follow on YouTube, Facebook, or Instagram. Leave all your comments below. Be sure to tune in next time. Next time we've got Dave Zook. He's going to do some of those ATM type conversations. He's also going to talk about those dirty car washes. But Kyle, I want to say thanks again. Larry, as always, it's great to see you. Ladies and gentlemen, we appreciate you tuning into the Tax-Free Cash Flow, and we will catch you next time.
See ya.
See ya.